everyone deserves to get the assets they're entitled to in a divorce. But it's also important to know and understand the tax implications because there could be many, and that can cost you thousands of dollars you weren't prepared to send to the government. Well, with it being tax season, we have asked our financial contributor, Donna LaScala, to join us to explain what you need to know when getting your fair share of those assets. Donna is the president of Comprehensive Divorce Solutions. Donna is also a certified financial analyst, a registered financial consultant, a financial neutral. She is a board member of the Association of Divorce Financial Planners, and she's also the president of the Long Island chapter of the Financial Planning Association. Donna, welcome.
It's so nice to be here, Ilyssa. Thank you for having me.
So nice to have you. And April 15th, commonly referred to as tax day, is creeping up, which means we are in the thick of tax season, as we just said in the opener. And having said that, what are the tax implications people need to be aware of when they're going through a divorce?
So it's a very complicated situation when you're talking about equitable distribution. And then when you add in the tax implications, it can make people's heads spin. One of the biggest issues is capital gains tax. And this is an issue on non-retirement assets, such as a stock or mutual fund portfolio, or even bigger, the marital residence. So this is where the term cost basis of the asset is very important. So let's discuss the marital residence, for example, because it's usually one of, if not the biggest asset that a couple has. So let's say the house is sold before the divorce is final. So in that circumstance, the couple is still legally married. They have a joint tax exemption from capital gains of $500,000. So let's say the house was purchased for $600,000, and then $400,000 of capital improvements were made. They dormered the house. They got a brand new kitchen. They got brand new bathrooms, a roof. All of those things are capital improvements. So the cost basis of that house is now actually $1 million, 600 plus 400. Now let's say the house is sold for $1.5 million. There are $500,000 of capital gain. $1 million of cost basis, $1.5 million of sell price, $500,000 difference. That's capital gain. Now, as a couple, as I said, they have a $500,000 exemption. So in that case, there's no tax owed because it's exempt. However, if one person assumes ownership of the house and then sells it post-divorce, that individual now only has a $250,000 exemption. So therefore, capital gains tax will be owed on $250,000 of the gain. Let's run those numbers. $1.5 million sale, $1 million of cost basis, $500,000 of gain, less $250,000 of a single exemption, leaves $250,000 of capital gain, which is taxed at least 15 to 20%. So at a 15% rate, that's $37,500 of tax that will be owed. And so when you're talking about what's going to happen with the marital residence, it needs to be discussed as far as who's going to keep it, when is it going to be sold, and what are the tax ramifications on that sale.
What is tax harvesting, and why might it apply to a divorce?
Okay, so tax harvesting is a methodology that's used to examine a non-retirement asset, such as a stock or mutual fund. So when you purchase a stock or mutual fund in a non-retirement account, so your regular brokerage account, hopefully that asset has increased in value since the date of purchase. And if you then go to sell that asset, there could be tax ramifications when the asset is sold. So this happens when cash needs to be generated in an equitable distribution. So let's talk about an example. So spouse A needs to generate cash in order to pay spouse B a lump sum, and non-retirement assets are going to be used. So it's important to know, again, the cost basis of the asset and how long it's been held. because there are short-term capital gains and potential long-term capital gains on a non-retirement asset. So tax harvesting is when you look at the asset, and if you've held it a long period of time and you're reinvesting your dividends or your growth into the asset, you need to know what the total cost basis of that asset is. And so let's talk about a stock. You owe 200 shares of IBM, for example, but you've had many shares accumulating over a period of time. You want to sell the shares that have the lowest possible potential for capital gains, and this is known as LIFO, last in, first out. Or you may look at a total portfolio and say, okay, there's an asset in here that actually has a capital loss because it's worth less now than when I purchased it 10 years ago. And in this particular circumstance, that's actually a good thing, because if you sell a position that has a capital loss, you thereby negate the potential for capital gains tax to be paid by the seller.
When a couple divides the assets in a divorce, and again, it all really depends on what they have, one side may be entitled to employee stock options or restricted stock units. Now, this may sound like, ooh, cool, free income, but you say there could be major tax implications people need to be aware of. What are they?
So it's always very interesting when it comes to restricted stock units and employee stock option plans. You'll hear the terminology RSUs and ESOPs. Okay, so people ask, is this income or is it an asset? Because an RSU or an ESOP is usually given as deferred compensation as part of a total compensation package, and they're not taxed in the same way as ordinary earned income. So if spouse A, by virtue of employment, has received any of this and needs to give a value to spouse B, those stocks either need to be converted or sold, and they will trigger a tax implication, which right now could be about 22% on the sale.
What if one of the parties in a divorce action is a military veteran, and that same individual is enrolled in either basic or the enhanced STAR program?
Okay, so we know that there are more and more people in the silver or gray divorce space, people over the age of 55. What if one of them is a veteran and they own a home, and that person, by virtue of being a veteran, has qualified for special tax exemptions on the tax owed on that house, the property tax, the school tax? What if they are not the person that's going to retain ownership of the home? So that special veteran status no longer applies on the home, and the person that retains the home is going to have an increase in their taxes. This can be something that's not even thought about in the grand scheme of things when dividing these marital assets, that the person retaining the asset is now going to have a higher cost of carrying charges on that property because they are not the veteran. They don't qualify for that enhanced program, those special benefits. So it's something that needs to be taken into consideration. And this is why it's so crucial to talk to a CDFA or a CPA before you decide how you're going to divide these assets.
Donna, for people who want to learn more, how do they get in touch with you?
You can call me at 516-234-7522.
Donna LaScala, President of Comprehensive Divorce Solutions, thank you so much for joining us. We will be right back.
At Comprehensive Divorce Solutions, Donna LaScala provides the tools for people to deal with assets, debts, equitable distribution, and retirement in divorce negotiations. We hold your hand during and after the divorce process, providing a roadmap of what happens next and into the future. Divorce is difficult whether you're initiating it or not. It's fraught with emotion. When you deal with emotions, you are not dealing with logic, making it more difficult to decide what to do with your money. Hiring a professional to assist you in walking down the money path is crucial to avoiding potentially costly mistakes. Donna's goal is to make sure that each individual knows how they are going to be able to survive and thrive during and after divorce. As a CDFA-trained mediator and collaborative financial neutral, Donna helps people get unstuck and move forward towards their post-divorce future. Call Donna LaScala at 516-218-6919, 516-218-6919.